Hi, my name is Aaron Stahoviak with Global One Financial Group. Global One Financial Group offers portfolio management and advisory services for a wide range of clients, from individual investors to large institutions. We not only manage clients' funds, but also have business partnerships with a variety of alternative investment firms, commodity trading advisors, and registered investment advisors. And the reason I'm putting this video together is lately we've been receiving a lot of questions about the stock market from clients and the public, basically wondering if the stock market's going to keep climbing like it has been since 2008, which looks like it's going to the moon, or if we're due for a crash. And so I put this slide together that has some videos. I've tried to put it in as short video as possible, but there's a lot of information and it is important to show everybody so everybody can understand. And I can't say I can guarantee, but basically if everybody spends time watching this, they can completely see the markets in a different frame of light that they've never seen before. How to trade alongside with the financial elite versus against them. So we're actually establishing our clients' portfolios. So we're taking a small allocation. We're not betting the farm. We're not saying, hey, all our clients, let's put 100% into this short trade to profit from a crash. But we are taking small percentages, 2%, 3%, depends on the client's aggressiveness. Some clients will have a little bit more liquidity. We're doing 5%, and we're putting into a trade that's going to profit from a stock market crash. And it's a financial derivative trade that I'll get into later, but it has a potential to make 40 times, to increase in value 40 times or 4,000% in value if we have a financial crash that dips below the 2008 lows within the next 2 years. So if the crash doesn't happen and everything is peachy and the economy moves forward and everybody's doing great, real estate values go up, business levels go up, then the clients only lose the small portion, the allocation that they submitted to the trade. But if we do have a crash, that small little allocation, let's say it's $10,000, and if that grows by 40 times, 10,000, that's a $400,000 that 10,000 can turn into. So that can definitely prove to be a profitable way to protect one's portfolio of, say, real estate or business investments or anything like that, to profit from a stock market crash, or at least protect themselves, or what's called hedging or offsetting their exposure to if the economy and the stock market keep going up. So anyways, let's go ahead and move forward with the slides. And again, I just wanted to show you guys a very high probable trade, a way a lot of people can protect themselves and make a lot of money if this event does occur. And also I wanted to show everybody on these charts what the financial elite look for and the way they look at the long-term view of the financial markets versus a short-term view. They're looking at historical patterns that are hundreds of years long, versus the average investor is only looking back a year or two or whatever, and they're not looking for those high probability times. So all right, let's go ahead and move forward to the next slide. All right, the first thing I wanted to go over is why the news and the financial markets confuse the average investor. A lot of times good news will come out and the markets will go higher. But a lot of times the good news will come out and markets will go lower, and vice versa with bad news. Sometimes it makes the markets go up. Sometimes it makes the markets go down. And so what I wanted to explain, and everybody can get basically a visual of why the markets do what they do, is just give a little analogy. All right. And you guys can pause this and read this later on. I'm just going to go with my little analogy here and then move forward. So imagine if we had a rowboat of roughly about 10 people in it, and say 8 people are on one side and there's 2 people on one side. Okay. So we can have good news or bad news come out. Let's start with the good news. The good news, let's say let's say a boat pulls up handing out $100 bills on the side where there's 8 people on. Well, of course, the side that has 2 people on are going to come running over trying to get their fair share of the $100 bills, and they're going to actually cause the boat to capsize, and everybody's going to be forced to run away from the good news. So the initial reaction is good, positive, to run to the good news, but then it's to run away from the good news just to save the boat from capsizing. And so that's just an example of how good news can initially cause the reactions expected, but then cause an opposite reaction. And the same goes in effect for bad news. Let's say the shark came pulling up on that same side of the boat with the 8 people. Okay, obviously those 8 people are going to run away from the shark. So what's anticipated, what's expected, is the bad news creates a movement from people, participants, or people in the boat to run away from the shark. But now let's say on the opposite, just so everybody understands this, the shark came and swam up next to the side of the boat with the 2 people in it. Guess what's going to happen is those 2 people are going to run away from the shark to the other side of the boat full of the 8 people, but then the boat's going to start capsizing, and then they're all going to be forced to run to the side of the boat that has the shark on it. So there's a perfect example again how bad news initially can do what you think it will, but then the people in the boat do the opposite and run to the bad news just to save themselves from falling in the water. So that's just an analogy of how bad and good news can affect the markets. It's not necessarily what the news is. It's just that it's a catalyst. It's just an event that causes a reaction. And the reaction depends on how many people are loaded on the boat. So back to the stock market, it depends how many people are buyers or holders. If there's too many buyers in the market and you have good or bad news come out, it can create selling and and create a stock market sell-off. Just like on the opposite side, if you have a stock market crash and everybody that's wants to sell has already sold and there's nobody sellers left, it doesn't matter if good or bad news comes out. It can create a catalyst, which is going to in turn create buying, and because there's no more sellers left, so there's only buyers left, and then all of a sudden the stock market will start rallying, even though it was bad news. So that's just an example of how a lot of people get confused by the news because, it's always switched around, and this guy on TV says this and this, and that's why everybody's bewildered when it comes to the stock market. And, all it takes is just taking yourself out of that mindset of what the news is and, if it's good or bad, and just looking at the psychology of the market and crowd behavior and what side of the boat is loaded. And that's what I'm doing with our portfolios, and what I look at are all these charts and everything I keep track of, and what I'm about to show you guys right now. And I think once I show you a visual of these charts, you'll completely understand what I'm saying of how the markets do this fake out trick basically all the time. So all right, let me go ahead and move forward to the next slide here. And I just have one last thing on there on this slide right here. The wisest thing to do is to basically go with the crowd till the boat's close to capsizing. But then once you see signs the boat's about to capsize, that's probably about the time that you should, go to the other side of the boat, knowing that anytime it's a matter, everybody else is going to be forced to the boat anyways. Don't be one of those suckers that are last on the other side of the boat. So, all right, let me move forward to this next slide here. All right, on this chart here, this is a chart that anybody can Google. All you got to do is Google Dow historical chart, and this will pop up, and it's from Stock Charts, I believe. And this is a chart of the Dow back all the way to 1900. And I just wanted to show everybody's when they think of the stock market, they're so into what's happening during the current time, and they don't look back and say, well, what's happened over 100 years? Because human psychology takes a long time to develop, and historical patterns take a long time to develop. So I don't want to just look at what's happened recently, and I'm using my cursor here, if you can see, pointing at what's happened since 2008, or this crash we had from the top in 2007 and 2008, or the tech boom that happened here from to 2000, or the crash in September 11th here, or here we have this is the real estate boom that I was in that made I don't want to look at that. I want to look at all the history back to 100 years, and I've even looked at charts back farther than that. But let's just stick with the basics here, all right? The first thing I wanted to point out is how markets constantly do what's called false breakouts. They constantly break above previous highs, and then just as everybody's suckered in by all the good news and the headlines and the talking heads on TV, and the market spanks them. Everybody loses, and then they throw in the towel in at the last possible moment, and then the cycle repeats itself over and over and over. Okay, and then the elite, the financial elite, the smart people, the smart money institutions out there, and well-known, well-off investors, traders know this, so they wait, and so they basically buy on sale when everybody's panicking, and then they ride the wave up, and then when it's time to signs are showing that things are doing great, the economy's doing good, everybody's out spending money and living it up, that's when they're selling, and they're preparing for a rainy day and putting their money away, and then they're waiting for the next panic, collapse, world event, who knows, whatever it is, wars, who knows, and then as soon as things are on sale, they do the same thing again. So I just wanted to point that out. This chart looks like probably a lot of gibberish to a lot of people that aren't used to looking at charts, but let me just point this out here. See if I can get there we go. All right. So this is starting back in 1900, and we have our first peak here where I'm pointing my cursor at, and if you draw a horizontal line to the right, the price of the market barely popped above that, and what happened? We had a stock market crash, all right, over 50%, just about 50% correction. So then the next time, that was try number one, we'll call it. All right. Then the next time the stock market broke above those past highs from try number one, we had another correction. And then we rallied again. That was try number two, okay? And then we corrected, it looks like about 40% or so. And then we rallied again for try number three above here. So it took 1, 2, 3 tries, and then again we corrected and had another about 50% correction. And the next time finally we broke through was time number 4, and this was the Roaring 20s, which led to the crash of 1929, which is a 90% correction. You can see here it's huge. But just what I wanted to point out, though, is it took one false breakout. So in other words, all these, I don't want to call them suckers because there's some poor people here that got sucked in it, but all these people got happy. The economy's doing great. Guess what? Not, and they got taught a lesson. And then the second time good news happened, they got taught a lesson. Third time, it took 4 times for the market to finally build up enough buyers, enough pressure in there to release into the roaring 20s, which was about a 9-year bull market. And we'll get into more reasons of why this inflation happened here, all right? But so then let me move forward then. So now after that, we had the crash of 29. Then we had the Depression era in the 30s. And then we started into World War II. And now the market put in a high. And it took another, looks like about 10 years for it to break above it. So that's try number 1. The market didn't really correct it just settled down a little bit, and then finally try number 2, boom, we're off to the races for another 20-year bull market into the mid-60s. And there's a lot of reasons that I'll get into in a little bit here that was a reason why it only took for one, you got to look at, we had a 90% correction that wiped everybody out. For 2, we had the end of World War II, which is a very good, very positive catalyst. Everybody was happy. Let's make babies. Let's go invest, and let's go start a business. And it was what I consider basically it was the peak in the United States at the time. You know, it was everything was good, but that led to a 20-year bull market. So I want to move forward now. That was the Dow. This is another chart that everybody can look at by looking at just Googling S&P historical, and it's just a little more zoomed in, and I can show you patterns easier. Right? This is the S&P back into the 60s, and I want to show a pattern again. So we just had that 20-year bull market after World War II into the 60s, and now we enter another time of consolidation, a chop. Okay, so again, here we have a high, and then as soon as the market broke its high, it went for quite a ways. But then guess what? It failed and had a correction. It wasn't a huge one off the top of looking here. We had about, let's see, 10, 20% or so. All right. And so what did the market do, though? Again, it broke through those highs. As soon as it broke through those highs and has good news and made the headlines again, and TV is around during this time. It wasn't the first time in the 20s, but TVs are on now. And then so as soon as the headlines are good again, try number 2, guess what? You get a 50% correction. Where'd my mouse go? There we go. All right. And then so now after that second time, we took a third time. Finally, we broke out above again. Is this the one? Are we finally going to take off? Third time's charm? Nope. Another more than 50% correction, and we crashed again. And it finally took for the 4th time for us to break through. We still had another little correction. And finally, the 5th time is when we broke out to this huge bull market that everybody in today's time got spoiled by. And so from 1981 all the way to 2000, at 20 years, we had a bull market. And everybody can just think about it. All the movies in the 80s and 90s, everybody's doing well. They're all at the country club. They're all driving nice cars. They're all in the stock market. They're all doing it. This is a great time for people. And unfortunately, a lot of people got spoiled by this time, and people could rely on their pensions, people could rely on their savings accounts making 5, 7, 8%, and now we're in this consolidation time that we've had in the past here, and that we've had in the past in the 1900s before we had the Roaring 20s. So we're at this period again now, and a lot of people right here that have just really experienced this bull market right here. Well, I don't even call it bull. It is a bull market, but it's just what I consider this is consolidation. All right. So we're in this time now where the market, we had its peak in 2000, and then we had the tech crash. All right. And then we had September 11th right on here. We bottomed. The market rallied. We had Alan Greenspan lowered rates down. What I thought at the time was real low. I was in the mortgage business and making a killing and rode this real estate wave up. Lucked out and sold a bunch of properties, not because I knew about economic cycles then, but because I could just kind of see the signs of everybody I knew was in the business, and it was time to get out. Every block had a title company. Every party I went to or whatever, real estate was the talk. And I'm starting to see those same signs again now. So it's just all the signs where it's like, you know what, let's get out. So I went ahead and dumped properties here, which is smart, but I learned my lesson, and I was out spending money then instead of preserving it and putting it away to save for a rainy day to buy and sell like smart investors do. And so now I'll always be on that side. But let me get back to this though. And so we had this bull market here, and we barely peaked above 2000, and then what happened in 2000? The market crashed and it broke below the 2003 lows, 2002 and 2003 lows there. So now that was try number one. So now we're back at it again, pushing above here, and this is try number two. So is this going to be like the 60s and 70s where it took 4 or 5 times of false breakouts? Is it going to be like the 1900s where it took a few times? Or is it going to be like right after World War II where it only took a couple times and we're off to the races? So that's kind of what I wanted to point out here, is a lot of people get caught up in it just remembering this time or just remembering this time. A lot of people think that this won't ever happen again because this was so dramatic, and it really made the news headlines. And for today's generation, including myself, this was dramatic. But if you look at 100 years, 50% corrections happen all the time. I can count them left and right. Let me go back. I don't want to go to that chart yet. We'll go back to another chart in a little bit. But, there's a 50% correction. There's a 50% correction. There's a 50% correction. We go back in the 1900s, there's a handful of 50% corrections. So crashes happen all the time. I think off the top of my head, there's about 9 of them in the last 100 years. So as much as everybody thinks that we would never have this craziness that we had in the credit crisis, in the markets in history, this is old news. This happens all the time. So it absolutely is possible. I bet you the people here at the top in 1973 didn't think that they were going to have another 50% correction, yet that's exactly what happened, and we did have another correction. So same is here. And you can see this pattern here. This is called an ascending triangle, a broadening top. It has higher highs, I'm connecting with my cursor, and lower lows. It's like a triangle pattern. And the same thing's going on now. We're having higher highs and we're having lower lows. So here we had 1, 2, 3 highs. We got 1, 2, 3 highs. And here we had 1, 2, 3 lows. Here we have 1, 2. We haven't had our third low yet. And that's the next chart I was going to show you. Is this that broadening top or that expanding triangle pattern. And this is technically what is possible, even though it doesn't seem like it's possible. History has proven it over and over again. It's possible that it can happen. If this does happen, then we're right now at the peak of this. We're breaking above our previous highs, sucking all the good, all the good headlines. Unemployment's low, the economy's doing good, and this is what sucks everybody in. And then bam, it catches everybody off off guard, and we have a correction. And yes, it is possible. History has proven that we can break below these 2008 lows, and that makes sense. This would freak the world out if we broke below these 2008 lows, and would flush everybody out, and everybody that had anything to do with the stock market would be so sick of it by then. And that is usually when stock markets finally take off to the races. So who knows what could happen then? Maybe the Federal Reserve come out and will say something crazy, like one of the tools that they can use is lower fractional reserve banking. Maybe they come out and say something like, you know what, we're going to change the fractional reserve banking reserves from 10% down to 5%. So all of a sudden there'll be banks loaning money left and right, and then that'll finally get the stock market off and up and running. So anyways, let me click to the next slide here. This is that same Dow slide that I was showing you guys earlier. And this just shows what I was talking about, how everybody, it was so spoiled by these 80s, 90s bull market. But in the grand scheme of things, if you look at this, we don't have bull markets one after another after another. They're separated by years of consolidation. Here in the 1900s, look how many false breakouts. Remember I was showing everybody earlier we had. That was all considered consolidation. Then we had the bull market of the roaring 20s. Then we had the crash. Then we had another consolidation period where the market didn't really go to new highs until after World War II, right around, was it mid-40s, we started really skyrocketing and going into that 15 to 20-year bull market. And then here we are back in the 60s and 70s. We had 20 years, basically 15 years of consolidation before we finally took off to that bull market. And now here we are from 2000, which was it fresh in everybody's head right now. And everybody thinks that the stock market's going to go on forever. But again, going off of history, what does history tells us? History tells us that you have 15, 20 years of consolidation, 10-year bull market, 15 years of consolidation, 20-year bull market, 15 years of consolidation, 20-year bull market. Well, we're at 15 years of consolidation now. Is this the one that's going to take off and launch us to, basically 10 times the value? Down here, the Dow was at 10,000, and we got up to 17,000. That's 17 times. So if we're at 17,000 now and took that times 17, I mean, you're talking Dow 100,000. I mean, above. So are we at that point right now, or are we going to have what's proven in the past, another basically a fake out, another correction, and shake everybody out? Then maybe we can launch to a new bull market. And that's why our firm and myself have lightened our exposure on our long side, and we're actually setting up what's called hedges, or basically trades that will profit from a market crash with low risk but a high reward. So, all right, let me move on to the next chart here. This is that same Dow chart, and I just want to show you guys I don't want to say the reasons, but causes for these bull markets. And a lot of times these bull markets happen because of our government and our Federal Reserve, and they create inflation. And here in the 1900s, and again, you guys can pause this and look at this later. I don't want to go on to forever. But these were lowered reserve requirements for the banks and lowered rates, which caused a lot of borrowing and a lot of spending, which created this bull market, which contributed to it. Let me say that. Here we had the Great Depression and the crash of '29. So we had what was at the time called the New Deal, which gave savings accounts FDIC insurance, comforting depositors. And then also we had the Gold Reserve Act, which basically confiscated the banks and citizens' gold, and they bought it for $20.67 per ounce, and then right away they established a price of $35 an ounce. So they basically just inflated their balance sheet and created money out of thin air, which helped create also this next bull market that we led to. Now here in 1971. We had what was called a Bretton Woods system. So basically the US dollar can be converted to gold. Well, in 1971, I believe during Nixon time, we got rid of that. Basically said, nope, that's not going to happen anymore. And so that from that point on, the US dollar became the world's reserve currency. So, and we import more than we export. So import our oil, we import all stuff. So basically what that means is we can have a money press. We can print money out of thin air, and as long as we're the world's reserve currency, we can print our way out of our budget problems. We can print our way into wars. We can print money left and right like we've been doing, and like a lot of people have been waking up and noticing the last handful of years of how much debt this country is really building up. So again, these are reasons for inflation. So although right now I'm building in our fund and my own personal funds, I'm building a short position with this creation of money that we're basically the Federal Reserve has been printing lately to create this rally that we've had here. I think once it does make its way to Main Street, then we can have a huge market rally. But history has shown me that there's a lot of false breakouts before rallies happen. So I'm not going to be the sucker that's going to be caught up here. I'm taking profits. I'm preparing. And what I didn't do with this peak here this time, I am preparing for a rainy day, and so I'm going to be the ones that if this does prove to be true, I can turn around and buy on sale down here and then ride that next wave up, which I do think, even though I'm what's called bearish, basically I think the markets are going to correct. Overall, in the long run, I think this can turn into a huge 20-year bull market after that correction, which could potentially be the roaring 20s of the 21st century, just like we had the roaring 20s here in the 20th century. So, all right, let's move to the next slide here. And again, that was just showing you that consolidation. Again, reminding people that the markets like to consolidate and build energy, consolidate and build energy and then take off, consolidate and then take off. Well, I think, again, the markets are telling us we're in a consolidation period here. So, and then I just want to go through some charts really quick. These are ones I prepared. This line right here, just for kicks, I showed right here. This is the crash of '87, Black Monday. That was such a huge deal, and it shows in comparison how big that is compared to what we're dealing with now in the financial markets. And this first line that I plotted was from 95 all the way up to the top of the tech boom. This same line I carried over here and I carried over here, comparing it to the boom we had in the real estate market and comparing it to the boom we've had now since the lows in '08. It just shows you the severity of how fast we're basically almost climbing straight up in the air. The markets are at a pace right now. It's a much stronger move than we had in the 90s and into the tech boom, way stronger than the real estate boom when the economy was healthy. And now that we have, I'll just leave my comments out of that, basically a propped up economy by the Federal Reserve, you can see that, you know, the stock markets are almost straight up in the air here. So it just shows, is this healthy right here? I'll let you be the judge of that, but I'm not one that thinks it's healthy. Right, and I think I have maybe one or two more charts here. You don't have to read. This is a chart I had prepared, just showing you, these traps. Basically, the market will break above, and then as soon as it breaks above, we had a 7,500 point correction down. As soon as we broke below these 203 lows here, then that's called a bear trap, and then the markets have rallied about 10,400 points since then. But the main thing I wanted to point out down here, this is a 30-year. This is a chart of a 30-year bond. And for 32 years, this is respected. The bonds have respected their trend line. So basically what I mean is every time bonds have sold down, they bounce off of this kind of like imaginary line that technical traders and institutional money watches. So bonds are still in an uptrend, but this is the interesting part. I drew this gray line straight up so you can compare. Bonds are like the dog that wags the tail. They're twice as big of market as the stock market, or also known as the equities market. So as equities have rallied, bonds have also rallied. So a lot of smart money, a lot of institutional money, it takes a lot of power to make these markets move up and make these bonds move up. And they've moved up at the same time stocks have. So that's telling me that smart institutional money is basically not trusting this right here. The dog is not trusting the tail. So they're putting their money in here, and these bonds are paying 1%, 2%, 3%, not 30-year bonds, but basically all the fixed income out there is paying astronomically low rates right now. So why would an investor want to invest in something that's paying 1% or 2%, something like that? It's for protection. They're just trying to protect their capital now so they don't lose it, versus if they have it all in the stock market, and the stock market has a 70% correction, they lose everything. So this is just another little tell showing that because bonds are going up along with stocks, this is a tell that the stock market is not healthy up here. And smart money, somebody that's a lot smarter than me, institutional money, knows that, and there's proof of this right here. There's a footprint right there that they're putting their money into bonds. All right, what I wanted to show everybody on this chart is this is the Dow, showing again that expanding triangle pattern, that broadening pattern. And this is the high from the tech boom in 2000. and this is the high here in the real estate highs, real estate boom, and then this is the highs, what I call the Fed Reserve driven rally. And then again, these are the lows here. This is the lows in 2002 when we had a correction. This is the crash of '08. And then this down here is an indicator that a lot of institutional firms look at. I don't really look at indicators too much. I like to look at price action and human psychology. But what I do notice on these is this is the relative strength indicator. There's divergence on this. And what that means for everybody that's not familiar with that term is as price pushed up here, I plotted this orange line here showing the peak in the relative strength indicator, okay? And it goes straight up and it shows how high price got at that point. Well, you notice after that, price continued to climb higher, but the relative strength, the momentum, failed to make new highs. It actually did not climb as high. So that was kind of a tip-off showing that there was a weakness about to come, which is exactly what happened. And we had the credit crisis or the crash of '08 happen here. And then at the same thing is happening now as the relative strength has pushed and made a peak. That lines up with this orange line right here. Since then, in the last half a year or so, prices continued, the stock market has continued to climb higher while the relative strength the momentum has not continued to go higher. So it's again signifying that the momentum is running out and they could be giving us another tip off that we're about due for another correction. Then also, if you look at the large time frame, you'll notice that on every peak that the stock market goes higher, the relative strength has made lower and lower highs. So not only it's on an individual on a short-term basis, looking at the years here and every rally we've had, but on the long term, from 1995 all the way till present times, the momentum has slowly gone down while price has gone higher. So this is not only showing what's called divergence on basically on two different time frames, giving us a heads up that this is not a healthy market up here. And again, it's not a high probability time to be too greedy if you've made money from this up here, and it's actually a high probability time to hedge or put some type of short trade on to profit from a market correction. During any of these times are low probability, but now that we've broken above these highs, this is the time that basically institutional smart money is taking profits. They were smart enough to buy down here when the public was panicking, and they're taking profits up here. So anyways, let's go ahead and move to the next slide. All right, next chart I wanted to show, this is a chart of the Federal Reserve stimulation in the stock market. A lot of people don't realize how, I don't want to say artificial, but how propped up the stock market is right now, up at this Dow 17,000. We started down here at 6,600-ish roughly, and that's when the Federal Reserve began stepping in and doing all this quantitative easing, the TARP bill to help out bail out the banks, and then buying all the bad mortgage-backed securities off the banks, buying bonds off the market to basically to keep interest rates lower, which were to help the public, but it also has helped our government be able to afford their bills because interest rates are low right now, and to be able to afford our bills to other countries that have loaned us money. And everything in orange is showing something negative. Like here's an example. Bernanke, our federal chairman Bernanke, tells Congress to step down in quantitative easing could come soon. And you notice anything that was a negative, it created a little sell-off in the market, Well, the goal by the Federal Reserve was to shoot for a 6.5% unemployment rate before raising interest rates, and we've overshot that now. We're at supposedly 6.1 and 6.2, something like that. And so now it basically is the time for the Fed to really, they don't have a reason to keep with all this money printing basically. And you'll notice again I've showed you this pattern. Now the market has broken over the previous highs. So again, it's a high probability now that the Fed's not going to be doing their free candy, what they call the punch bowl. They're taking the punch bowl away. And rates can be going up. This could create a stock market sell-off. Let me go ahead and move on to the next slide here. And this is the last slide I have. This, again, you guys are familiar with this. This shows the Dow for back from the 90s, and it showed the peak here in 2000 with the tech boom. It showed the peak in the real estate boom, and now we have the peak in what I call the Federal Reserve, stimulation boom. But notice at the bottom here, this is the volume of the New York Stock Exchange volume. So I drew lines again to coincide. The volume at the peak in 2000, I drew this green line here just for a reference line. All right, that was, look at the volume there in 2000. Now look at the volume in 2008, how it went higher, all right? But now look at, since then, in this new rally, where's the volume at? It's not only way below 2008, it's below where it was in 2000. It's about half of what it was in 2000. So this is kind of proof. Again, it's the signs showing you that nobody really wants anything to do with the market up here. And another little thing I noticed too is traders and institutional money can use equities or stocks, which have unlimited risk and unlimited reward, and they can use options, which have a limited risk and an unlimited reward. And you notice on every so distance here, there's basically a space. These are called options expiration days, and they occur once a month. You'll notice they happen all the time, but in this last, basically in 2013, with this low volume, it's pretty consistent. Once a month, those are very high. So that's kind of a sign showing me that anybody that's having any smart money, any institutional money having to do with the stock market up there, they're playing it. In other words, they're having an involvement in case it goes higher, but they're using a lot of options to be a participant in it, because options have a limited risk. You can only use what you paid for the option. And so this is why you see this high levels of options expiration, much higher than you ever have in the past, and so consistent once a month on the dot. Those levels are higher when the options expire that month and they have to close it out and go to another month. So, all right, let me go to the next slide here. Okay, so after all those charts, and thanks for everybody for making it through all that, and I hope everybody learned something from it, but we can see that markets they have a high probability of false breakouts and false breakdowns. We see that the last rally we've had since 2008 is very steep, and it's all been charged or driven by the Federal Reserve. And so how can we profit, or how can we protect ourselves from a stock market crash? And that's what I'm going to explain right here. And I just have this on right in front of me on a screen. I didn't memorize it, so if I sound like I'm reading it, that's because I am. To profit from a stock market crash, our firm's managed portfolios are using financial derivatives known as option contracts. Stocks, also known as equities and futures contracts, have an unlimited reward, but also have an unlimited risk. This is why the majority of investors who have rode out the stock market crashes before have seen their holdings drop in value while riding out crashes. Since the year 2000, buy and hold investors have had to ride out two 50% crashes. So basically, in the last, since 2000, if you've been in the market, you've had to ride out two 50% corrections. Options are financial instruments which offer an unlimited reward with a defined risk, a risk that is capped to the amount paid for the options contracts. Options are similar to insurance policies. If the risk event does not occur, then they expire worthless. If the risk event occurs, the option contract increases in value. Options guarantee a price to buy or sell at in the future. Options also use leverage, so the reward or gain can compound, resulting in large returns. Although leverage, remember, the risk is capped to what is paid for the option. So basically, options are a way to participate in the move, cap your risk. But because they're leveraged, if the event does happen, in other words, if we are positioned for a stock market crash and the crash does happen, because of leverage, they really pay for themselves. They really increase in value. But on the other side, if the event doesn't happen, our risk is capped to what we paid for the option. This creates maximum gain versus reward while capping risk and losses. This strategy works best during high probability entries into financial markets. The majority of market participants do not have long time horizons or study market histories and enter during non-high probability times, hence why the public so often is frustrated with the stock market. Institutional firms are very patient and look to buy on sale from the public and sell to the public for a profit when markets make highs and the headlines are positive. So again, I showed you charts from the past 100 years. That's exactly what institutional money is doing, is they're looking at the long-term patterns and they're waiting patiently for those high probability areas like a predator ready to pounce. They're not getting mixed up in the middle of the stuff, like from basically from 2008 till 2000 now. They're not really doing anything in there other than small stuff. Their major moves that they do, they're waiting for those crashes in 2008. They're waiting for those times where we break above previous highs to go ahead and dump to the public for a profit everything that they bought on sale from the public when they were freaking out and selling out of panic. So that's kind of what we want to do, is align ourselves. When I say we, not only my clients, myself, but everybody out there, public, we want to align ourselves with the financial elite and play the same game with them instead of fighting them and doing the opposite of them all the time. And the financial elite are constantly on the right side of the trade and making money from every financial crash or boom. All right, so next point I want to make out is waiting patiently for these high probability entries and exits is what's made many of the well-known Wall Street investors their fortunes. Warren Buffett, I can name a handful off the top of my head. These investors know where high probability areas are, where people are exiting, where the boat's crowded, so to speak, where the boat's loaded on one side. They know how to buy in panics, and they know when to take some profits. And again, that's just off of market psychology and what I was showing you in this historical charts, how markets like to do false breakouts, fake people out, make it everybody think it's good news and the markets are going to take off to the moon, and then also false breakdowns. Just when they break below previous lows and the world's coming in, the markets bounce back and they rally, and they're always shocking people. So all right, and then on to the next thing. So making money from the stock market crash. How much is possible to make? My client's allocation in what we're doing is we're allocating, it depends on every client, but we're averaging about 2 to 4% of a portfolio. Some clients they really believe in a crash and they're actually going higher than that. So I'm not saying everybody should go out and bet the farm that the markets are going to crash, but it can't hurt to take 2% or 3% or 4% of your allocation, your portfolio allocation, and dedicate it to a trade like this. So, if the markets don't crash, then you only lose your 2 or 4%, whatever you allocate. If they do crash, that 2 or 4% could turn around and turn into 40 times that amount. So let's say, for example, somebody wanted to take $10,000 and dedicate it to a short trade, take that times 40, and you're looking at $400,000 that can turn into. So that's why it's such a high probability time to enter a short opportunity or to make money on the short side, in other words, from a market crash. 4,000% or 40 times is very easy to make in a high probability time, but that's the two things. You have to, one, know when a high probability time is to enter the markets, which professional institutions do, and they're patient. They wait like predators ready to pounce. And then two is what instrument to use, which was where the option derivatives come in, because they are a high reward and low risk, because your risk is determined. So the worst case scenario is you lose what you paid for the option derivatives. So, all right, let me move on to the next slide here. All right, so now we've discussed how to profit from a financial crash, or how to protect your portfolio and have some exposure to if there's a financial crash, so you can protect your profits or profit from that. The next question I'm going to go ahead and get to, next point I'm going to get to, our firm, again, I've already described, we deal with registered investment advisors, commodity trading advisors, advisory services, and then of course we manage our own portfolios as well. One of the most common questions I'm asked is about managed accounts, separate managed accounts, and I'm going to go ahead and describe a little bit about that, since I'm asked about this all the time. What is a managed account? Again, I'm just going to read this off the screen. Managed accounts are separate SIPC, which stands for Securities Investor Protection Corporation, insured accounts under your personal name or legal entity, and can be logged into to check balances and withdraw or deposit funds just like a savings account. So basically, if you want to set it up under your personal name, if you want to set up under a business, you're allowed to do that however you want, and it's separate, so the account is in your name only, nobody else's name. It's basically set up like a savings account, and your funds are only in your name. Again, they are not grouped with others, such as with traditional hedge funds. No person or entity, including our firm, has access to clients' funds. Only authorized signers on the account have access to funds. That's why these separate accounts are very popular. A lot of people like them. They're being able to participate in the hedge fund world without having to fork over a check to a hedge fund. We have the same, in a managed account, we can participate in the same type of trades as hedge funds, same financial instruments and derivatives, but the clients like the fact that their funds are in their name and they can check the balances, they can log on, they can have control over them. Accounts are set up under an advisor account with an S&P stable credit rated brokerage, allowing our firm to allocate funds to investment instruments, which all are visible and transparent by the authorized account holder via online access. Our partnership brokerages are worldwide established brokerages with $5 billion plus in equity capital, rated stable by Standard & Poor's, and have locations in the United States, Canada, Europe, Hong Kong, Australia, India, China, and Japan, basically worldwide. And then the last thing on here, if anybody has questions on any of the brokerages that we use or the clearing firms, please feel free to get a hold of us and we can provide more information on that. So, all right, I hope that that basically puts in a nutshell what managed accounts are. A lot of people are confused. They come to me saying, Aaron, I'm curious. I really want to try it, but it's something that's new to me. I'm not really quite 100% sure how it works. Then feel free to contact our firm, and myself or somebody from our firm will contact you and answer these questions. But basically what I just went over, it's a separate fund. It's a separate account in your name that only you have access to. You can log on to it every day. You can withdraw money out of it. You can deposit money into it. And you can obviously check the allocation, whatever your funds are allocated to. And as a manager, as Global One Financial Group or whoever is going to manage your funds, we are only allowed to allocate the funds in your account, but nobody has access to your funds except for the authorized signer, which is yourself, for your entity, or if it's a personal account, just yourself. So, all right, let me go ahead and move to the next slide, and then we'll wrap up here. All right, everybody, that's a wrap. The video definitely ended up taking a little bit longer than I thought, but it's definitely hard to put 100 years of historical data and thousands of hours of my own research into a small video. But if everybody helped everybody be able to see that the markets have a rhyme or reason of why they rally and why they crash, then it was worth it. Obviously, this took some time to put together, but if it helps everyone have a better understanding, then it was worth it. And just pass it forward, in like a pay it forward manner. All my contact information is on the screen in front of you on my social networking links. My email is on there, aaron@globaloneFinancial.com. If you have any questions about setting up an account or advisory services or anything like that, please feel free to get a hold of me. And that's it. It's been fun. Have a good one.